The Sarbanes-Oxley Act of 2002, normally referred to as SOX, is a landmark piece of legislation enacted in response to major corporate scandals in the United States, including those involving Enron and WorldCom. The act was designed to enhance corporate governance and restore public confidence in the nation's financial markets by imposing stringent regulations on financial reporting and accountability practices for public companies. Sounds like a heavy topic, right? But stick with me because this law affects every accountant who works for a publicly traded company, and trust me, it's something you'll definitely want to know about. Here's the cool part. It's not just for big corporations. Even many not-for-profits are jumping on the Sarbanes-Oxley bandwagon because it shows they're serious about tight financial controls. This is especially important if they want to raise funds and build trust with donors. So let's get into how SOX shapes the way companies keep their financials in order. All right, here's the scoop. The Sarbanes-Oxley Act of 2002 was passed in response to some massive corporate scandals. We're talking about Enron, WorldCom, and others. These scandals really shook the public's faith in corporate America, and the US government was like, enough is enough. SOX is all about trust. It's the US government's way of saying we're going to make sure companies are playing fair and being transparent. The act was passed with overwhelming support, 423 votes in favor in the House, and a nearly unanimous 99 votes in the Senate. President George W. Bush called it the most far-reaching reforms of American business practices since FDR. SOX is packed with 11 sections that lay out the rules of the game for public companies, their boards of directors, and the auditors they work with. It even extends to privately held companies in some areas like the destruction of evidence in federal investigations. So why did it come into play? Well, people were outraged by the lack of accountability in companies that crashed and burned, costing investors and employees their hard-earned money. SOX was passed to rebuild investor confidence by ensuring companies report honestly and hold their executives accountable. But not everyone was thrilled. Some critics argued that the costs of compliance are too high, especially for small companies. On the other hand, financial experts argue that it's been a game changer, making financial reporting more reliable and transparent and bringing back trust. Let's get into the nitty-gritty. What are the key sections of SOX that every accountant should have on their radar? Here we go. Section 301. This one's big. This section focuses on audit committees and their responsibilities to oversee the integrity of financial reporting. Specifically, it mandates that public companies establish procedures to handle employee complaints related to questionable accounting or auditing matters, with an emphasis on protecting whistleblowers. Section 302. This is the section where the CEO and CFO now must certify that the financial statements are accurate and free of material errors. This also means they're personally responsible for making sure internal controls are in place and effective. If things go south, they're on the hook. It's no longer, I didn't know. And on the hook means all their personal assets, house, cars, etc., are at risk as well. In many large corporations, the CEO and CFO require that all finance leaders sub-certify first, meaning that the CFO and CEO won't sign until their direct reports have signed off as well. When I worked in large corporations, I had to sign off on a large SOX statement that basically said that I wasn't aware of any hidden issues. And guess what? I was signing off as well with my personal assets on the line. So it's something to do to be taken very seriously, and you certainly don't want to work for a company that doesn't take SOX seriously. Section 404 is all about internal controls over financial reporting. Public companies must now include a report on internal controls in their annual reports. And guess what? External auditors must verify that the company's internal controls are actually working. Talk about a check and balance system. Section 406 is for the senior financial officers and promotes honesty, accuracy, and compliance. It's not just about looking good on paper, it's about setting the tone for ethical behavior across the company. Now let's talk about why Sarbanes-Oxley is taken so seriously. It packs a punch when it comes to penalties. Section 802, if you're caught altering, destroying, or concealing documents with the intent to obstruct a legal investigation, you could face up to 20 years in prison. That's not just a slap on the wrist. It's a serious penalty, and it's meant to stop anyone from trying to cover up fraud or wrongdoing. Section 806. This section is a whistleblower's best friend. If you report fraud or illegal activities and you face retaliation from your employer, you're protected. Even better, the Department of Justice can step in and criminally charge those responsible for retaliation. Transparency is king, and SOX has got your back. Section 906. The CEO and CFO can't just sign off on financial reports without consequence anymore. Under this section, they must certify that the financial statements fairly present the company's condition. They knowingly sign off on inaccurate info, they could face up to $1 million in fines or 10 years in prison. And if they willfully certify false information, the penalties skyrocket to up to $5 million and 20 years behind bars. Talk about serious accountability. So here's the big takeaway. Sarbanes-Oxley might seem like a set of dry regulations, but it's shaping the future of corporate governance. It's pushing companies to be transparent, accountable, and ethical. And for accountants, it's a non-negotiable part of the job, especially if you're working for publicly traded companies. SOX is rebuilding trust in the business world, ensuring that when companies report their financials, they're doing it honestly and accurately. So the next time you hear about corporate governance or financial reporting, remember that SOX is the law that ensures companies aren't cutting corners or pulling the wool over investors' eyes.